Hey everyone, my name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in there. Let's take a look, see what people are sharing. If you want to follow me, it's at Finding_Finance. And if you want to join our community, finding-value.com is where I dive deeper into all these topics, looking for potential investment opportunities uh, for individual companies. And I do a lot of technical analysis. I do a lot of, some fundamental analysis. Sometimes I go over the company's presentations and go through them with the community during question and answer sessions on the weekend. We do have a May Day coupon that is still active at this time. So Rick Rule says, so simple, yet folks don't see it. And it's Milton Friedman. He said, keep your eye on how much the government is spending, because that is the true tax. That's exactly what's going on right now. We've got incredibly high government spending. That's that fiscal train that everyone's talking about that can't be slowed down. That's government spending. It's a tax on all of us. And that's where a source of inflation is coming from. It's also why some of the indicators may be held up inverted, aka inverted, for so long because fiscal spending continues to pump and pump and pump, and it acts as a stimulus in the system. Here's that liquidity. Global liquidity is entering the explosive cycle. And I know a lot of people are wondering what's coming back into the market. This here also, if you kind of look at the liquidity cycle here, could indicate maybe that's why they might lower interest rates, or maybe they do some sort of stimulus, quantitative easing, balance sheet expansion. I don't know exactly what. Now, if you look back in history and you were to compare some of these cycles of liquidity, we've got a low of liquidity in 2001, 2002. That also coincides with a weak dollar during that time frame. And that was when the last commodity bull market really went higher. It's when we went from 2001 2, which was the slowdown in the markets, to that liquidity coming into the market, and then the eventual slowdown in 2008. This liquidity cycle doesn't run perfectly with the real estate cycle or business cycle. So think of this as like impulse movements into the market of liquidity, and it doesn't exactly match the business cycle. It's similar, but it's not perfect. And right now, it looks like we are heading higher for the liquidity index, which means maybe liquidity comes into the system, which is AKA money or credit, and that's going to put pressure on certain assets to go up. So in '06 onward, oil did really well, each of these liquidity events for a lot of them. And then when they drop, big liquidity movements backwards, sometimes oil does poorly, but it also needs to align with the supply and demand balance of oil. And right now, oil is incredibly tight. We're still tight in terms of inventory levels. So when this liquidity enters the market, it's entering it when oil is in a tight supply demand part of the cycle. I think this is going to be highly good for oil prices and probably also platinum. Platinum also has been basing out. We've been basing out ever since this liquidity fell off a rock here. And this is now coming back into favor. And it's very inflation sensitive. Gold does real well when this slows down. When we were slowing down 2022, that's when it got kicked off when it was real low down here. But gold can also keep going higher even as liquidity comes into the system. It does front run this liquidity run. The lawmakers, central bankers, and banking systems as a whole increased the broad money supply by 38%. Price inflation begins moving through the system. Revenues, expenses, and profits rise because the denominator is falling. More money chasing the same amount of stuff is a weaker dollar. Makes sense. Lynn's got it, I think, pretty well buttoned up here. Autism Capital. It says one of the spot on things that Peter Thiel talks about on Joe Rogan is that we haven't seen enough technological advancement in the physical world. We've seen endless advancement in software and with computers and screens, but the quality of life of the physical world hasn't improved that much comparatively. This is what makes builders like Elon and Palmer unique and interesting. They're tackling problems that have physicality. We should work on financially incentivizing physical builders more so that the best and brightest minds don't go into the next crypto or artificial intelligence grift and instead go into moving humanitarian physically forward. Here's the thing though, guys. Improving software, I think, is easier. So technological advancement, uh, all it is it's a gap. It's filling a gap between the physical world and a design. So technology is more or less, it doesn't change the physical world. It doesn't reconfigure the atoms per se. Most of technology just improves on efficiency. So when they do an improvement could be fitting more resistors in a smaller area, storing more space in a smaller, more confined area. Mining is mining more ounces or obtaining more ounces out of ton picked out of the ground, given the same ore grade uh, percentage. So it focuses on efficiency. To change the physical world is really difficult. And that's where I worked. I worked on changing the physical world, building physical things. So you can see technology, software, and all this stuff go at a million miles an hour, but it doesn't really change the physical world all that much. It doesn't change a way that a home is built. It doesn't change the efficiency of things that have almost set minimum requirements of energy input and materials input. You can't make a 3,000 square foot house necessarily with a ton less material. Because in order for it to be 3,000 square foot, you need the material for it to be built at 3,000 square feet. It's like saying, I want 1 pound of lead to weigh less than 1 pound of lead. It's like, yeah, I mean, a pound of lead is a pound of lead. And software is just working on the interaction between humans and the efficiency from putting their inputs to the outputs. It's a totally different game, and I don't think they can be compared. So people may think that got like a dog fight going on back here barking. So people may think that software development and the technology and these huge advancements, what I am telling you is the advancements they're not as big as what most people think in terms of shrinking something down and being a little bit more efficient with space. I don't think that's mind-blowingly different versus teletransporting someone from A to B like Star Trek. Now that is like out of the world. How the heck did they do that? Coming back. Well, it's possible that AI right now, it's like the internet in 1999. It's a bubble, and it will take 2 decades to find a use for it. And I think that's exactly what's going on. I think he nailed it right there. And what's even more weird is the tech bubble in 99 is exactly when the commodity bull market launched. We're in the same exact situation with artificial intelligence today that we were in the internet in 1990. Completely agree. Here's for your information Google search. So this is the searches and then the watts per request. Google search, ChatGPT, Bloom, AI-powered Google search, new state research, and AI-powered Google search semi-analysis. Everything is going to start using more and more energy. Well, where's that energy going to come from? What's going to be provided? This is electricity consumption per request. Coming from natural gas is my guess. Because if it's not going to come from uranium, because we can't build the nuclear fast enough. And it's not going to come from coal because coal's too dirty. That leaves pretty much only one option. And I highly doubt it's going to come from solar or wind. And even if it does come from solar, they still need to build the natural gas power plant as the swing producer. It's incredibly inefficient. The best thing you could do is just completely skip solar and wind and just build solid state baseload power to a certain level and then have some natural gas to swing it up and down. That's the best idea because you build the least amount of minerals, you have the least environmental impact, you've got the least impact probably to even climate change, even though I don't believe in that. And then you can support all these searches that I guess people are going to do. The single biggest perk of being self-employed, and I hate to say this, guys, I didn't know about this. And this is completely true because this is what I'm using as well. It says you can set up a private 401k plan for yourself and your spouse and get a $138,000 tax deduction, and then use it to invest in absolutely any asset class. Here's why the solo 401k is the most powerful retirement account in America. For each person, you can do up to $69,000 in tax deductions, 138 combined if you've got a spouse. It's super hard to max out a corporate 401k plan because you can only contribute $23,000 a year as an employee. But you can also, and this is not 100% right, you can contribute up to 23,000 as pre-tax money. You can contribute up to 69,000 in after-tax money in a Roth 401k if there's an option to do that at your work. So you can still take advantage of this 69,000 and you can put 23,000 in pre-tax and the rest in a Roth 401k, or you could put all the money in a Roth 401k depending on your circumstance for taxes. So it says with your own company, you can max out your employer contribution to hit a 69. So he has that wrong, just an FYI. And what I do is you can only put a certain amount of your employer contribution into it. Your max that you can contribute is 25% pre-tax of your salary. So if you pay yourself, make the math easy, $100,000, you can put $25,000 as your max pre-tax employer contribution. But then it's 23,000 plus 25 is 58,000. So you can put in another chunk of money on top of that if you want to do after tax contributions to a 401k to hit the maximum 69k. I know that seems a little bit confusing and maybe you can play that multiple times. It says invest in any asset class at all. Most corporate 401k investment options are very limited. With the solo 401k, you can set it up to invest in anything you like. Individual stocks, ETFs, bonds, or even real estate, startups, crypto, or venture funds. That is correct. Tax-free growth. You don't pay any taxes once the dollars are in your solo 401k and the money compounds tax-free unless you do an approach where you pay taxes up front and it can grow tax-free in a Roth 401k, which is what I would suggest with some of the money is what I would do. You only pay taxes when you withdraw dollars in retirement. This leads to faster growth and more money available when you retire. It also depends on how much you make. If you make obscene amounts of money, you want that money to grow tax-free because if you're a little bit younger and you compound that money, more of that money is going to be part of the growth than your contributions. So it's actually more powerful to look at a Roth 401k than it would be to just do pre-tax money, in my opinion. It says support for Roth contributions and mega backdoor Roth. And this is where things really get interesting. You also have a choice to put in post-tax money and never pay taxes on it again in retirement. You could even do a mega backdoor Roth and contribute up to $69,000 per year into a Roth IRA doing this. You could borrow up to $50K from your plan. If you need cash for any reason, you can borrow up to $50,000 or 50% of your account value from your solo 401k. The best part is Even though you have to pay a market interest rate, the interest goes back to you in your own retirement plan. You're basically your own bank. So if you amass a big account value and you need to borrow up to $50,000, you can use that as a down payment to buy a house, to rent the house out, or something like that, and then pay yourself back over time. You get a $500 tax credit for setting one up. If you set up a solo 401k and use a provider like that, that lets you enable automatic contributions. You qualify for 500 EACA tax credit, and I didn't even know about that. So that's a solo 401k. I actually use it. I call it and I do both pre-tax and Roth 401k money. I had to set it up in two different accounts because one of the brokerages did not offer a Roth 401k option. Peter Brandt, silver is either the granddaddy of granddaddies of all cup and handle patterns, or number two, a disappointment. History will prove silver to be just a basic raw material commodity, not a precious metal speculative store of value. What are your thoughts? Please repost for Peter Brandt. And here's the big move lower, and then the move higher here, and then the consolidation. One thing I will say is this. This here was a decline in interest rates, an increasing interest rate environment, a decline in interest rate environment, and we're going into an increasing interest rate environment. I think because we're going into an increasing interest rate environment, it's going to behave like we bottomed here from the 40s all the way forward. I think it's going to break this continuation cup and handle pattern and be an absolute moonshot to the upside. So when looking back to the early 1930s, when it bottomed, that's when interest rates bottomed and then turned higher. So there's a correlation between interest rates moving upward, bond markets moving downward, and money rotating into gold, silver, platinum, and other physical metals and physical assets. That's what I think. Here's URNM. Chart tells us all just saying, and this is, in his opinion, a potential bottom where we start to move higher. I'd like to see some follow through or some basing here. This is what occurs. You come down and then you base a little bit at the bottom here. I want to see that base sideways for a little bit. And that would provide a good entry point, low risk entry point. We are seeing the momentum, the stochastics turn upward though, which is usually a good thing. Central banks are hoarding gold faster than we've ever seen. This is central banks hoard gold at the fastest pace on record. I'm sure you guys know this, but look at how much gold they're buying here in tons. That's insane compared to history. The interest rates have an impact here. We had a very low interest rate environment way back in the 1910s and 20s. It bottomed in the 30s and 40s. Then it came back up. This was an increasing interest rate environment here. You can see there was some selling here towards the end of that. The end of that regime that ended in 1981-82. Then we came in and you can see all the selling pressure here over the years, and now we're coming back buying after 2008, when they did all that stimulus and money printing in the system. The gold silver ratio, it's coming. Stay focused. He thinks it's going to break to the downside for this gold silver ratio. I do too. We could stay high for a little bit. We could even have a false breakout to the upside and do a double top, which is possible if a slowdown does occur. But I'm not so sure about that. I do think we could, if inflation comes and we go into this commodity bull market, financial assets underperform, I think silver is going to outperform and go lower. It's the timing of that in the short term that's the question mark. But overall, I do think this is a good move lower, like he has it. Well, this is quite interesting. Natural gas electricity generation grows fastest into the 2030s in the net zero scenario, according to Princeton's update modeling of U.S. emissions pathways. So we've got natural gas growing into the 2030s here, guys. 2030s for electricity supply. Crazy. Another one from Silver. He says silver should be at $70 to $80 according to gold current price. Just saying. So he thinks that the gold-silver ratio is going to compress and catch up to gold. And that catch up, gold should be $70 to $80 an ounce. I actually agree with that. I think we're going to see gold $70 or $80. That could happen this year or early next year. It really could. Wyckoff market cheat sheet. I just forwarded this on. We don't have to go over it, but Wyckoff has these accumulation periods at bottoms. They've got distributions at tops, and it's important to know these because if you can recognize these, you can get some good entry points out of this. Many investors find it very difficult to do nothing. People tend to think there's a bonus for activity in investing when there most certainly is not. I wanted to read this. This is Graham. It says, "It is so much easier emotionally to follow the crowd than to be a contrarian. In addition, many investors find it very difficult to do nothing. People tend to think there's a bonus for activity in investing when there most certainly is not." And that is from the Charlie Munger and Ben Graham opinions there. Okay. This is the gold priced in consumer price index, and we're starting to break this to the upside. Absolutely profound effects here because this is when the mining companies start to outperform. Huge opportunity here when gold outperforms the consumer price index, aka inflation. Here's retail sales group. It says, does this look like a US recession? US retail sales grew much stronger across the board in July. The control group, which strips out volatile spending components of food services, autos, gasoline, and building materials, rose by an impressive 6.8% on a 3-month annualized basis. So in addition, retail giant Walmart lifted its yearly outlook and stated, "We aren't experiencing a weaker consumer overall. Hence, the odds of a soft landing in which the Federal Reserve is happy to cut rates remains pretty high, creating a potential Goldilocks environment for stocks." So that's stronger U.S. retail sales here, which is surprising. All the negative recession calls out there. So I'm trying to get a balanced approach there. But that's what I've got for today. That's the end of it. Give me a thumb up for the content, guys. Subscribe to the channel, subscribe to the website, and we'll catch you guys later. This is Finding Value.